Real-time trading rules after the PDT rule. Impact on small account options traders. Executive summary, the end of pattern day trading restrictions. On April 14, 2026, the SEC approved FINRA's elimination of the pattern day trader rule, removing the $25,000 minimum equity requirement that restricted retail day traders for over 2 decades. The new framework, effective June 4, 2026, replaces the binary PDT designation with real-time intraday margin standards where buying power is calculated dynamically based on actual position risk rather than arbitrary account balance thresholds. Brokers have until October 20, 2027 to fully implement the risk-based monitoring systems too. This represents the most significant regulatory shift for active retail traders since the rule was implemented in 2001 following the dot-com crash. The change opens unlimited day trading to accounts with as little as $2,000 in margin equity, but introduces new risk-based constraints that vary by broker implementation. Timeline of PDT rule elimination. Date. Milestone. September 2025. FINRA Board Approval 3. December 29, 2025. SEC filing. April 14, 2026. SEC Accelerated Approval 1. June 4, 2026. Effective date. October 20, 2027. Final implementation deadline 2. Regulatory changes, FINRA Rule 4210 amendments. FINRA's amendments to Rule 4210 eliminate the entire day trading margin framework including the pattern day trader designation, the $25,000 minimum equity requirement, day trading buying power calculations, and all PDT-related margin calls and 90-day account freezes. 1. The new intraday margin standards under Rule 4210 paragraphs A. 17 through A. 19 and D. 2 require broker-dealers to monitor customer accounts for intraday margin deficits regardless of trading frequency. Brokers can implement either real-time monitoring systems that block trades creating margin deficits, or end-of-day calculations that trigger next-day margin calls. 5. Small deficits defined as the lesser of 5% of account equity or $1,000 are exempt from enforcement actions. Accounts that repeatedly fail to meet intraday margin deficits within 5 business days face a 90-day freeze on creating or increasing short positions or debit balances. 6. The regulatory framework shifts from trade frequency limits to capital adequacy requirements commensurate with market exposure at any point during the trading day. 7. What now limits small accounts? Real-time constraints. Under the new framework, traders are no longer asking if they are allowed to trade, but whether their account can support the trade right now based on real-time margin excess. The $2,000 minimum margin account requirement remains in effect as the baseline threshold for buying power is calculated based on margin excess at the time of each opening transaction rather than the previous day's 4:1 leverage multiplier that applied only to PDT accounts. 1. Intraday buying power resets throughout the day as positions are closed and profits are realized, allowing capital reuse within the same session. 8. Concentrated positions exceeding 50% of account equity trigger higher margin requirements with a 40% surcharge in some implementations. 9. Cash swept to bank sweep products or money market mutual funds can now be included in buying power calculations, expanding available capital for some traders. 1. The shift eliminates trade counting but introduces dynamic risk-based limits that may be more restrictive for volatile positions or high-risk instruments like 0DTE options. 10. Constraint type. Old PDT framework. New intraday margin framework. Account minimum. $25,000 minimum to avoid PDT restrictions. $2,000 minimum margin account requirement, unchanged. Trade counting. 4-day trades per 5-day rolling period for accounts under $25,000. No trade counting, restrictions based on real-time margin excess. Buying power calculation. 4:1 intraday leverage for PDT accounts, over $25,000. Based on margin excess at time of each opening transaction. Intraday capital reuse. Limited by 4 trade cap for small accounts. Buying power resets as positions close and profits realized. Concentrated position rules. Standard margin requirements regardless of concentration. 40% surcharge for positions exceeding 50% of account equity. Cash sweep inclusion. Not included in buying power. Cash and bank sweep products and money market funds now counts toward buying power. High-risk instrument treatment. Same margin for all options. Dynamic risk-based limits for volatile positions and zero DTE options. Broker comparison, implementation approaches. Robinhood, Webull, and Interactive Brokers are taking different approaches to implementing the new intraday margin framework. Robinhood shares rose 7 to 10% following the SEC announcement, with analysts projecting the rule change could boost trading activity by 3% and add 1 to 2% to 2027 sales revenue. Robinhood's margin book more than doubled year-over-year to $16.8 billion in Q4 2025 and reached $18.4 billion in January 2026. 11. Margin loan growth comparison. Broker. Q4/Q1 2025. Jan/Q1 2026. Growth. Robinhood. $16.8 billion, $18.4 billion, plus $1.6 billion, plus 9.5%. Interactive Brokers. $64.36 billion, $89.21 billion, plus $24.85 billion, plus 38.6%. Interactive Brokers demonstrated significantly stronger growth in absolute terms, adding nearly $25 billion in margin loans compared to Robinhood's $1.6 billion increase. This reflects Interactive Brokers' larger customer base and higher average account balances. Implementation strategies and market positioning. Webull announced immediate implementation of PDT removal, positioning itself among the first platforms to adopt the updated model and enable unlimited intraday trades as long as margin requirements are met. 8. All three brokers offer commission-free equity options trading, though index options carry per contract fees ranging from 35 cents to 55 cents depending on membership tier. 12. The competitive differentiation now shifts to margin terms, risk controls, execution quality, and real-time monitoring capabilities rather than trade frequency limits. 8. This represents a fundamental change in how brokers compete for active traders, with the focus moving from regulatory compliance thresholds to operational excellence and risk management infrastructure. Robinhood, real-time monitoring and gold benefits. Robinhood maintains no minimum account balance for standard accounts and offers commission-free trading on equity options with no per-contract fees. Robinhood Gold subscribers pay approximately $5 per month for enhanced features including higher cash APY, better margin rates, and IRA match benefits. 12. The platform's pattern day trading policy historically required $25,000 portfolio value to continue day trading after being flagged for PDT, with portfolio value excluding crypto positions, futures positions, or available margin. 13. Under the new framework, Robinhood will calculate buying power based on real-time margin excess rather than previous day's closing equity. 1. The platform offers 24/5 trading capabilities and fractional shares starting at minimal investment amounts. 14. Robinhood absorbs small regulatory fees that other platforms pass through to customers, making it slightly cheaper for active traders. The mobile-first interface prioritizes simplicity and automation over advanced charting and conditional orders. 15. Webull, advanced tools for active traders. Webull offers commission-free trading with no minimum account balance, providing advanced charting tools, extended trading hours from 4 a.m. to 8 p.m. Eastern Time, and support for short selling, futures, and commodities. 15. Index options carry a 50 cents per contract fee, or 45 cents with Webull Premium subscription. Webull Premium provides 3.5% IRA match versus 1% without the subscription, along with 3.6% APY cash sweep rate. The platform supports fractional shares with as little as $5 investment and offers paper trading for practice. 14. Webull passes small regulatory fees to customers but provides deeper analytics and customizable charting compared to Robinhood. 15. Extended trading hours and futures access give active traders more flexibility for intraday strategies. 12. CEO Anthony Denier stated the PDT rule removal creates a more consistent framework across account sizes and allows participation based on risk management rather than arbitrary thresholds. Webull's implementation focuses on measuring risk in real time using live market data rather than tracking and flagging pattern day trading activity. 16. Interactive brokers, sophisticated risk management. Interactive Brokers, IBKR, offers both IBKR Lite with commission-free U.S. stock and ETF trading, and IBKR Pro with tiered pricing for professional traders. 12. The platform provides the widest range of investments including stocks, options, futures, forex, mutual funds, bonds, and cryptocurrencies across over 150 market destinations. IBKR executes more than 2.7 million trades per day through its affiliates. 17. Founder Thomas Peterfy stated that smaller investors should be allowed to learn by trading a few shares or a single options contract at a time without being penalized for frequency, challenging the myth that smaller accounts are inherently more reckless. Interactive Brokers describes the shift from trade count limits to intraday margin level standards as a move toward a more physics-based risk model, managing risk based on actual volatility and exposure of a portfolio rather than counting clicks. 16. The platform offers portfolio margining capabilities and sophisticated risk tools suited for experienced traders. 12. IBKR's implementation leverages existing real-time monitoring infrastructure developed for institutional clients. 16. Practical implications: what improved vs what got stricter. Improvements under the new framework. The elimination of the $25,000 barrier represents the most significant improvement, allowing traders with $2,000 plus to execute unlimited day trades without PDT restrictions. 28. The 90-day account freeze penalty for PDT violations has been removed, eliminating one of the most punitive aspects of the old system. Traders can now recycle capital within the same session as profits are realized, enabling more flexible position management and capital efficiency. Unlimited day trades for accounts with $2,000 plus equity, previously required $25,000. 2. No 90-day account freezes for PDT violations. Intraday capital recycling as profits are realized. 8. Cash and sweep accounts now counts toward buying power calculations. 1. Uniform margin standards apply to all traders regardless of account size. No distinction between PDT and non-PDT accounts. Cash and sweep accounts now counts toward buying power calculations, expanding the available capital for trading. 1. The new framework removes the artificial distinction between PDT and non-PDT accounts, applying uniform margin standards to all traders based on their actual risk profile and position characteristics. Stricter requirements and risk controls. While the new framework eliminates the PDT rule, it introduces more dynamic and potentially restrictive risk controls. Real-time margin monitoring can block trades before execution if they would create margin deficits, representing a shift from end-of-day enforcement to continuous oversight. 5. Concentrated positions exceeding 50% of account equity face higher margin requirements, with surcharges up to 40% in some broker implementations. 9. Real-time margin monitoring that may block trades before execution. 5. Concentrated position surcharges up to 40% for positions exceeding 50% of account equity. 9. Reduced leverage for volatile securities and high-risk instruments like 0DTE options. 10. 90-day restrictions on increasing positions after repeated margin deficit failures. 6. Variable buying power across platforms based on broker risk algorithms. 16. Less transparency compared to fixed rule thresholds of the PDT system. Volatile securities and high-risk instruments like 0DTE options receive reduced leverage compared to blue-chip stocks, with brokers applying different margin requirements based on their internal risk assessments. 10. Accounts that repeatedly fail to cover intraday margin deficits within 5 business days still face 90-day restrictions on increasing positions. 6. The trade-off: flexibility vs transparency. The framework relies on broker risk assessment algorithms rather than transparent rule thresholds, creating variability in buying power across platforms. 16. This represents a fundamental shift from the predictability of the PDT rule to a more dynamic, broker-specific implementation. While traders gain flexibility in executing more frequent trades with lower capital requirements, they sacrifice the clarity of knowing exactly what triggers restrictions. The same trading strategy may receive different margin treatment across brokers, requiring traders to understand their specific broker's risk calculation methodology rather than relying on universal FINRA thresholds. References: 1. Securities and Exchange Commission Release No. 34 to 105,226, File No. SR. 2. PDT Rule Eliminated, Everything That Changed, June 2026 Guide. 3. FINRA approves overhaul of pattern day trading rules, opens doors for 4. PDT rule change, what it means for options traders. 5. SEC approves amendments to FINRA Rule 4210 replacing day trading margin. 6. Pattern day trader rule elimination SEC FINRA 2026. 7. FINRA's intraday margin overhaul replaces outdated requirements. 8. Webull moves to remove PDT limits as new intraday margin rules take effect. 9. New FINRA margin rules 2026, what everyday trader. 10. Understanding FINRA's new intraday margin rule and the end of PDT. 11. SEC scraps $25,000 day trading rule, unlocking billions for Robinhood. 12. Robinhood vs Webull vs Interactive Brokers, U.S. Stock App Comparison 4. 13. Pattern Day Trading, Robinhood. 14. Webull vs Robinhood 2026, Intuitive Trading or Advanced Tools. 15. Webull vs Robinhood, which trading platform is right for you? 16. Flash Friday, PDT rule overhaul sparks industry debate. 17. Interactive Brokers vs Robinhood, comprehensive platform comparison.